Good,
Good to
good.
see you, Chris. So, rather than to have too much filler in here, I'm going to start right now. Um, so today I'm chatting to Chris Poch, the founder and CEO of Promethium Advisors. Chris has spent more than 40 years advising some of the world's most successful families and helping them shape the industry itself. And I've been lucky enough to get some of his advice for free, and I'm nowhere near the world's most successful families. He's built and led wealth management groups at Smith Barney, Citigroup, and later at Bessemer Trust, firms known for serving complex multi-generational clients of institutional level sophistication. Chris has had a big say in how private wealth management is practiced at the highest levels. Um, Last time I chatted to Chris, we talked about one of his books, Money and Meaning, and what I've learned from advising the very wealthy. Um, uh, and it was a really useful conversation, which kind of looked into some of the deeper questions of wealth, not just how to build it, but how to align it with values, which I had values, and family, which I do have, and a life of purpose. But most importantly, Chris is a lovely guy and doesn't show any signs of visible irritation with my dumb questions. Chris, thank you so much for joining me today. How's it going?
Harry, it's a pleasure to be here, and it's great. Thank you very much.
Um, so I wanted to, I reached out to you and I wanted to chat to you about that article you published recently in Forbes. How could AI impact retirement planning considerations for investors' 401k strategies? Um, so I know we're going to talk about that a little bit. I hope to also spend a little time on how your thinking has evolved, and what you're thinking regarding markets and investing right now. Forgive me, I have one thing in common with Richard Nixon. I'm dreadful at small talk. So I thought we could just dive in. Um,
Let's go.
so can you explain the thesis in the piece you published for Forbes?
Yeah, thanks, Harry. So I don't know how novel it is, but I think a lot of people are putting this together. So, um, as most people know, there is a narrative out there that with the advent of AI, we will be able to, at some point in potentially the very near future, take an individual and maybe take a couple blood samples and then put it through some sort of analyzer where a very sophisticated algorithm will be able to determine or detect some of the genetic challenges that each of us have as an individual, and then theoretically overlay our challenges with the known medical sciences and potentially concoct some sort of pharmacological solution that will be very tailored to the individual as opposed to people who are like me in a greater class. And the theory is that this potentially could identify problems earlier, treat us earlier, treat us better individually. So that's the narrative out there. There's a Wall Street Journal article just over the weekend that suggests maybe that's not coming fast enough for Wall Street's timetable, but that actually opens a different discussion we'll get into. However, if we are able to use the benefits of AI to help each of us or all of us collectively live longer, we need a plan to live longer. And as it relates to retirement plans, the average person at some of the largest custodians have the majority of their retirement plans, their 401k plans specifically, invested in target date funds. Now, most of your audience will know target date funds are basically a mutual fund option, or it's a default option actually, where the participant says, I am X age and I plan to retire in Y number of years. What happens is when you get to that year, the asset allocation, which is originally set based upon basically time horizon, and if you're younger, it might have 95% stocks, but as you get older, it reduces the amount of stocks and maybe the riskier stocks get peeled out. But ultimately, you get to your retirement age, and the mutual fund companies have basically 50% in stocks and 45% in bonds. Some of the more aggressive ones are a little bit more. Some of the more conservative ones could be as little as less than 10% stocks. What does this mean? Well, if we do live longer and our life expectancy at age 65 goes from 20 years to 30 years to 40 years, who knows what it might be, the question becomes, do you have the right asset allocation in your retirement funds post 65 or whatever it is? And a lot of people really don't know what that asset allocation is. They just sort of think, well, this is a big company. They're doing the right thing. And maybe they are. But if you have a 50-50 rate of return, and let's just say that, gets you, these are random numbers, 6% rate of return, um, versus a 70-30, which might get 7.5% rate of return or something with a higher equity exposure. The difference could be only a few $100,000 for some people, but it could be millions of dollars for other people. And this is an example of just a retirement plan concept where we have some pretty good data from some pretty big sources that are reliable that have been studied over the last many years. And unless people know about it, they may not do anything about it. And so that's the essence of the article.
Yeah, I think the longevity. I mean, I'm an old geezer, and at some point in my career, I was involved in fixed income asset management, um, and we all of us got the longevity assumption wrong, and that resulted in a huge bid for duration. A few guys got that one right, but a lot of people got it wrong. And it meant that we saw very aggressive asset liability management flows where pension funds were desperate to try and catch up with those duration bogeys that they were behind. And eventually it all worked out, mostly because stocks did well enough to take away the problem. But it wasn't the only place where we saw that longevity assumption. We got that longevity assumption wrong, and it had like big collateral effects. I think if you look at the big cities, big popular cities like New York or San Francisco or LA, um, we had a certain rate in which people would leave those towns and go off to the suburbs or go off to safer places because they were considered dangerous. In the early 90s, they weren't dangerous, but they were considered dangerous. Um, and all that flow out of those cities stopped, partly because they were safe, perceived as safer, perceived as better for kids, perceived as better for schools, but also because people just lived a lot longer. So if you had a townhouse in Carroll Gardens or um, the Upper West Side, you just never left it. You stayed there an extra 20 years compared to the people who had that townhouse before you. This had a huge effect, squeezing those real estate markets. Anyway, blather on about it. But the point I'm trying to make is simply that longevity assumptions pop up all over the place in asset markets
Yeah,
and
I
can have
mean,
a huge
just to
difference.
to that point, if you think about whether it's Taft-Hartley plans or any sort of defined benefit plan that has you know, not a whole lot of cushion. They typically are a little bit more conservatively allocated, which typically is a little bit more fixed income oriented. So the asset allocation may have only been, 55, 57, 58% stocks. And, the bond market generally for a long time did come down. So that sort of saved people's bacon. But it penalized the equity participation by a point and a half, 2 points, whatever it was. So it is interesting understanding the longevity element of it. Will people live this long? And if there's the liability tables, the insurance tables are all backwards looking. But if you get that wrong, and you're an individual, you're in big trouble. If the city or the state or the county gets it wrong, the taxpayer's in trouble. That may or may not impact you. So anyway, it's a big deal, and so it's just something I thought would be worth putting out.
Yeah. How much evidence is there that we're seeing that longevity effect in play? Is there any evidence for it at the moment, or is it all anecdotal?
I think it's all anecdotal. I mean, you can't prove life expectancy extension until after it happened. So,
Right.
this might be the magic of AI, the pixie dust that's being sprinkled on all of us, assuming that these probable solutions are going to happen much faster than they're capable of happening. But there is, in order to do these combinations, there's going to be a lot of science. And of course, there's going to be a lot of doubters, and there's going to be a lot of economic interests that are going to want to slow things down. So I don't know if it's going to happen. I don't know when it's going to happen. But I do believe that if we have the supercomputers and the speed, and the compute power, science is probably going to get there faster than many of us expected. Whether or not we'll be able to get targeted applications, the timing of that is who knows.
Well, I've been struck by some of the anecdotes I've seen as well. I'm sure you have, otherwise you wouldn't have written this. But one of the anecdotes I came across was about AIs looking at radiological pictures, X-rays, and or MRIs, and flagging up tumors early, tumors among other things. Um, you could see how this could easily, you know, uh, a lot of we could have a lot of early interventions and things which have taken lives. And but that doesn't necessarily guarantee quality of life. So there's like a second order effect. Um, People who spend money in retirement are usually healthy people, aren't they? So if we're just extending life, but people aren't doing very much, they're watching TV, like my kids, in a way. If we're all watching screens, we won't need as much money. The returns issue will be smaller. So we don't have a definitive thing. We have to guess a little bit.
Well, I guess for my case, it's guessing a lot. This is all above my pay grade as to whether or not it's going to happen or when it's going to happen. But I do think it's worth pointing out that most people don't realize that a target date fund is a 50-50 allocation. And, back in the day when we started, you and I, it was, a 60-40 allocation was the magic solution. And then it sort of drifted up and maybe it was 70-30. And whether it's 80-20 or maybe it's 100% perpetual Bitcoin futures, I have no idea. But the point I think is that if we really take a look at what our expected life is individually when we hit whatever this retirement date is, my guess is most people shouldn't be at a 50% stocks. My guess is most reasonably healthy people and people with affluence generally tend to be a little healthier for better or worse. It's just a fact that you're probably going to live an extra, 5, 7, 10 years beyond whatever the tables say, everything else being equal. And therefore, should you have your retirement assets, whether it's inside a rollover or anything else, should it be as conservative or 50-50, or should it maybe be something north of that, 75% stocks? I don't know. The cycles obviously will drive a little bit of that, but having the perspective that maybe a big chunk of your retirement savings are, underexposed to growth. That's really the primary point.
So, and another thing, so I was always pondering this, and I was doing my homework and reading through your piece. Um, there was a certain irony. I was on a conference call just this morning, and this is a regular call that I have with some buddies. Some of us are older than others. Believe it or not, I'm one of the younger ones on the call, which I think's a bad sign.
Was
But
it uh, was it a dial-up phone? Is that how you guys?
it could so easily have been. But no, we've managed to adapt to modern technology like Zoom. Um, but um, but yeah, that one of the things that struck me about that call was that so usually there are bulls on the call, and the bulls are always bullish. And there are bears on the call, and the bears are always bearish. And then there are some guys who are more flexible minded, less or perhaps more optimistic or less optimistic. I'm not sure, by disposition. But this call was unusual because everyone was bearish. Um, and I don't know if I'm bearish, but I'm open to those arguments. But I was really struck. I mean, the bears are always bearish, but a lot of the bulls had switched. And the message that I was getting from people was, so it's obviously a bubble. The bubble, it's an earnings bubble, probably. But that bubble will eventually burst. And what we don't know is whether that's a 30% drawdown or a 60% drawdown. Um, Now, there's a counter argument to this, which is if you don't know when it bursts, it could burst from a further 30-40% higher, and it would not be unprecedented. So generally speaking, like I'm at my minimum equity allocation right now, and my minimum is 30, and that's because I'm wrong. I'm often wrong. And I don't want to be any less long than 30%. because that's like about as low as it gets. So I just thought there's an irony about a longer term argument pointing towards a longer position in equities, just when some shorter term arguments might point to some shorter, right, less long positions in equities. What would you say to me in how to reconcile those two?
I think we all sort of cluster our thoughts around certain parts and that dominates our thoughts. And so what I would say is I think certainly there's a, exposure, there's risk, price risk in many parts of the economy and some of the stock prices specifically. Um, However, there's a couple things that are overriding that make me constructive. And frankly, I'm probably towards the long end, that the more heavily weighted in stocks, although you might gather from some of our comments now and before, is that I'm relatively cautious, or what I believe to be as a conservative investor, looking for the lower risk way to get to whatever the conclusion is. So, the first thing, I don't know if it's true, but I go by this principle that stock prices are driven by liquidity, then growth and value. And the primary element is the government is still spending, money supplies is increasing, assets, give or take, are sort of the same. And so in an aggregate basis, the asset values are going up. So that's sort of my underlying premise. Um, you know, I don't know whether you call inflation, CPI growth, what have you. It does feel like things are more expensive, which means asset prices are going up in some parts of the economy. I do think that there's price risk, in the tech part of the stock market for all the reasons that everybody knows. I don't think there's collapse risk. If you've got these hyperscalers and all these people that were, they hugely cash flow positive, and now the capex is sucking up everything, and it's anticipated they're going to go 30% negative or something. It's not unheard of that people just don't spend the capex regardless of what their commitments are. And they go, during difficult times, they say, sue me. So
Mhm.
I think that these cash positive machines, these great companies we know that have made commitments, whether or not they actually spend them, I think that will give them some sort of, cushion for a quote, a collapse. Secondly, I believe in whether it's a Donald Trump put or the Fed put or whatever, I believe that at some point, if it all hits the fan, in times where we saw a 30% market drawdown, I don't think we're ever going to get close to a 30% market drawdown until the current administration steps in and quote, saves the market. You and I are both old enough. I mean, I started in 1983. God forbid me to tell you the truth. But I was there for 87, where the market went down 22.7% in one day. And so people talk about the greatest crash they ever, but I was kind of rare there in one day. But we go back to COVID when the market just crashed, dramatically in one day, and the Fed came out, I don't know, that afternoon and said, we're going to buy everything. We're going to buy corporate bonds, we're going to buy ETFs, we're going to buy everything. And I don't remember what the S&P was up, but like the Dow was like 5,000 points that day or some huge number. And so I think that that is going to happen. If we get into some crisis mode, I think we're going to have a bailout. So as far as the economy goes, I think it's going to move around. And we've talked about different things. I think there are parts of the economy that really individual industries and some specific companies that they're in really good business models. They have unique products and services that will compound over the long term. And the prices are going to bounce around a little bit up and down, but I'm trying to stay away from the things I think have a significant price risk, anything that has liquidity risk. And we're focusing on things with great balance sheets that have long-term potential. So that's sort of the overall macro view. And this is what, in our opinion, families of multi-generational perspectives want. They want these compounders where you can hold them through cycles because they've got financial stability, because they're good businesses, they've got loyal customers. The prices are going to bounce around a little bit up and down, but if they tend to, have an upward slope on that chart, then we're going to own them long term.
Yeah, I with you on this, I think, which is that um, I struggle to believe equities can. oscillate within a range of return on equity of, I think, something like between 6 and 12%. And 6 is a low estimate. Returns on equities never usually get below 8, I think. Um, and so generally speaking, you want to have an investment which is returning something because money goes down in value, and stocks return something. I'm just not good enough to pick the 1 or 2 years out of 12 to 15 where they go down a lot. And so I want to be exposed to beta, generally speaking. And frankly, my stock picking is woeful at the best of times. Um, so I do my best to pick some sectors that I think have a tailwind, but generally speaking, robust businesses that are not going to go bust do a lot better than me. And that's what I really want to keep exposure to. However, I say that, and I can also see that we might be around the time, somewhere near one of those corrections. And I wrote some pieces, and one of the things I said in the piece I wrote was that I'm pretty sure we're in a bubble, um, and that's why I haven't sold anything yet, or I haven't sold any more, because I'm in my experience, whenever you're in a bubble, they just keep going, to the point where everybody believes they have to, it capitulates to the view, and it's around then that they tip over. It doesn't seem to me that everyone's capitulated to that view. Um, you sent me two other links, and I think you wanted to talk about them. One was on passive investing, and it kind of segs nicely with the target date funds, which is one iteration of passive investing. There was Mike Green uh, did a piece over the weekend, um, and I read the piece. Boy, he was pissed at Robin Wrigglesworth. And I can see why as well. Wrigglesworth was incredibly rude. Fatuous is a really rude thing to say about somebody else's analysis. So we shouldn't be surprised that Green bristled as much as he did.
Yeah.
Um, for what little my opinion's worth, I thought Mike had a point. Passive flows can drag markets a long way away from underlying values. Um,
Yeah. To that point, Harry, that sort of is the reason why you're still long where you are. And my basic premise, um, about generally staying long in something, and that famous quote about markets be can stay irrational much longer than you can stay liquid. So I think what Mike did a great job, and he's just such a brainiac, and always about a third of whatever he writes is above my pay grade. And I have to take my shoes off to do the math. In general, basically in this article, he talks about uh, active management doesn't prove that a lot of the people are stupid. It just proves that regardless of how good you are, regardless of how good active management is, the flows have just pulled money out of this, and it makes people who are looking for idiosyncratic opportunities probably just suffer unfairly. So and I think his conclusion, which is right, which is this is not going to stop until it stops, and then it will stop, and then it potentially we could have a tariff tantrum or 19 or excuse me, 2022 all over again when it turns really fast, and it amazes me that people, a lot of people, particularly not professional, have forgotten all about 2022. When Netflix was down 75 and Tesla was down 75 and the Nasdaq 100 was down 38 and bonds were down, you pick it 13, 18. It all hit the fan. The only thing that did okay was energy. Now, there were some specific things, but energy tends to trade countercyclical.
mhm.
So, I think Mike Green's article is really good. And I think having someone like you, or hopefully someone like me, being able to explain how um, a thoughtful approach to investment management over a multi-year period where you can ride out these known anticipated shock waves, and also understand the mechanics behind this, and that this incessant bid towards the largest cap company is not reinforcing their value. It's just reinforcing their current state.
Yeah, no, I was chatting earlier today with Julian, an old colleague of mine, and and as part of that conference call, and we were talking about uh, the internal correlations within the S&P 500 versus the volatility of the S&P 500. And stock correlations are about as low as they've ever been. So, which facilitates higher levels of gross risk taking because you get more portfolio diversification effects. And this kind of thing can reverse quite quickly, and all correlations can suddenly go to one in a hurry. And it does support Mike Green's argument. Another way of looking, or the inverse of Mike Green's argument, is we are bubbly, that we have a reinforcing mechanism which has helped certain stocks get very expensive. Now there's a counter, which is most of the time stock prices flows don't pull values that much out of kilter. So most of the time that's true. But I don't know whether we're in an exceptional period when the scale of these passive flows is such that we have got a big misvaluation within the market, not the overall level, but the relative valuation of different things. How likely is that? I mean, does that tally with what you're thinking?
You know, I guess what I would say is our guess, and it's truly a guess, is that there will be a rotation. There will be some fly in the ointment or some disclosed thing that'll come up in S1. It'll be like a WeWorks S1 where they're, doing multiples of community or some bogus term like that. And it will take the air out of the narrative. Um, and so I think that will happen and that will cause a rotation. It will say, okay, we had expected these things to compound at this rate for a long time, and then that compounding level, whether it's due to heavy capex or whatever the change is, will change the narrative, and the narrative will say, okay, this is more of a capex trade, so the earnings aren't going to be as high. If the earnings are not going to be high, or the rate of the growth of the earnings, then we're going to compress the PE from, infinite to whatever. And then you've got places like the memory chips, the announcement of the South Korean, $800 billion. Of course, it takes 5 years to happen, but all of a sudden there ends up being a student body left type of movement and people, shift out. I think that that's likely to happen. And, you're seeing some of these old world companies like Coca-Cola up 20% year to date, and Nvidia's up like 3 or whatever. So of course, don't ask about the last 5 years, but I think that there's going to be a rotation. I don't think there's going to be a collapse. And that's what our guess is when it happens. No idea. Will it happen? Likely. What'll cause it? I've got some thoughts, but they're just guesses. Our primary goal is not to be really wrong, and just
Right.
if we're not really wrong, we're going to end up being just fine over time.
Yeah. As my friend Corvin says, the thing about stocks is they go up. Um,
He's
and
right.
yeah, he's right.
He's right.
And he's a physicist, a PhD physicist, and he does like to get to the nub of the issue. Um, and yeah, I think that's the basic point, isn't it? And of course, it's very irritating to us bond guys. And the thing about bonds is they don't go up. They mean revert, generally speaking.
Well, and then, if you're in the corporate thing, there's only one thing that could happen overnight, and that's bad news.
That's right.
You never have
That's right.
some massive upgrade overnight by a rating agency. You just have a, default of some unknown proportion. So, I used to work at one of the big firms up in New York, and one of my buddies was a credit analyst, and he learned very fast. The reason why Solomon made so much money is they went overnight. They were short overnight. That's what happened. That's what they did.
Yes. Yes. Yeah. Um, I'm going to just briefly circle back, proving you completely wrong when you said I'm good at knitting together issues. Um, and I'm going to, but you've talked about the longevity point with others. How well received was this? What's the general feedback you've had on the longevity tailwind that AI might imply for equities?
The general feedback has been, yeah, I already knew that. So I'm not so sure that this was that innovative. And it's not necessarily something that anybody's going to write about because it's not that exciting. But when you talk to an average person and you say something like, well, do you have a target date fund? And he's like, well, I'm not sure. Yeah, I think I do. Or even a younger person who signs up, well, what did you do? Well, the default option was a target date fund, and I just click the box, or the default option is for an employer. And then you say, okay, how's that invested? No idea. I think it's growth. I looked at it. I'm not really sure. So I I don't know that this.
Oh, it's almost definitely, I mean, it depends on your age, right? If you kind of know how it's invested by how old you are.
Well, but people don't know that, Harry. I mean, that's what I'm saying. The average person's, well, it's invested and it should be for someone who's going to retire in X number of years. Well, what does that mean? The answer, I have no idea. So, what I would say is, we will start distributing this because it only published recently, not as some sort of aha, but as a conversation starter. And I think honestly, it's a decent piece that people would say, oh, that's interesting. It's not gonna make them rich or change their lifestyle. But I think it's worth a conversation.
Uh,
So
It's, it's definitely worth a conversation. And a good block of my career was defined by how important getting the longevity assumption right was, and people didn't get it right. As a result, they missed out on some huge moves across the board. And I think it's easy to downplay. Like quite often, the important thing to understand about markets is kind of simple and kind of slow moving. And the guys who win are the guys who see the simple, slow moving point and can sit still, affect, in a can just sit with it for long enough.
so
Um,
let me just play off of this because I've been in the business a long time, as have you, but what I find is people right now, they say, of course, I'm invested in the triple Qs and I'm this and that. And of course, I've got the tech fund. And right now, people don't need to be reminded in the stock market. But what will happen is there will be a correction. And if it lasts more than 6 months, people will start leaking out. Their 401ks will be 211ks. And then they'll say, I'm getting close to retirement age, right? And I can't afford to be any more exposed to the markets right now. We had a situation like this, and somebody called up and said, "Get me out." And that's always the exact wrong time to do it, right?
mm.
And you'll remember, you get these buffer funds, these downside protection funds, and the insurance products, and they all proliferate right after there's been some sort of meaningful downdraft. And it's the greatest time to put together, these structured notes and these products. You're putting 8 points in these jumbo things, and the dealers are making $1 skillion. And it's the, person who is undereducated, who doesn't understand this. They time it exactly wrong. And that's when I get, impassioned about this message. So right now, I'm not expecting a whole big expansion because there's so much drumbeat about, taking risk, being in the markets, trade, do Kalshi, predicts all this sort of stuff. So, it's not that big of a deal right now. After a difficult market, that's when I get up on the soapbox and try to say, listen to me. So hopefully this will help some people over the long term.
So, Chris, it's funny you mentioned Kalshi. Because if you were to ask me to give you an anecdotal indicator of proximity to some market dislocation move or the next big correction, I'd say retail participation. It's the best proxy for when we're getting closer to a market dislocation. Call it the shoe shine boy index if you like, something like. And one of the ironies here is that Mike Green's firm, Simplify Asset Management, one of their core philosophies is embedding convexity in non-convex products. So they'll buy options on, they'll find a cheap way of getting longer swaptions so that you'll have an outperformance on your bond fund if the market moves sufficiently. And if it doesn't, you'll underperform. So they're embedding. So Mike is talking about the degree of passive, a kind of reflexivity of passive flows, because to some degree it's part of his bread and butter. To some degree, I think he's right that there is a reflexive passive problem, and you can. I saw the other day Jeremy Grantham on a video with CNBC, and people were abusing him on the video. Joe Kernan was saying you've been wrong for whatever. And I thought to myself, that is the indicator that Grantham is about to be right. When you get naked abuse on CNBC, that's a positive sign that maybe we're in the early stages of it. Um, so, what do you think is an indicator, or what's if is there anything out there that makes you think, oh God, we're getting kind of close to some sort of correction?
Uh, well, I mean, well, let's just talk specifics. Of course, none of this is investment advice, but if you take a look at, what's making the AI trade work, and it's for the last several years, it's been the more money you spent on CapEx, the more you were rewarded for getting in front of this trade.
Hmm.
And it was a, winner take all. You had to have the most to squash out the competition. And and so that has been the continued drumbeat. The question about the longevity of the GPUs and CPUs, what have you, that was there. And then you went from, you needed chips to you needed energy to you needed data centers, and now it's you need water. What I think what's happening is the rate of the pricing of these big commitments. There's an estimate out there that there's $2.1 trillion worth of future cash flows that are being securitized to, raise money in order to build data centers and other things. And half of that's coming from, Anthropic and OpenAI. And Anthropic, appears to be the winner that has an 80% enterprise customer base, and their cash burns modest is under 10%, as opposed to OpenAI, which is, 60% consumer, and they're burning through cash faster than a, drunk sailor on Friday night. Um, and so, that's happening. And then everything's okay as long as the music doesn't, stop. Um, and what appears is, like that, one of my favorite movies is that movie Margin Call. And
Hmm.
Jeremy Irons is asking, the rocket science stat guy saying, so the music stopped. And he said, no, right now the music is slowing. But if it stops, it'd be orders of magnitude worse. And what you see is, the marks um, of open AI and what it's being priced, as long as that next bid is higher, it works until it's not higher. And right now we're seeing that the relative increase is slowing, and their, best partner, Microsoft, is backing away from, putting long-term commitments into OpenAI, and they're doing other things. And they've had, insight into OpenAI's books, from the start, if you will. And I'm wondering, why is it that Sam Altman decided he had to cut prices? What is it that he saw? Why is it that he just volunteered 5% of the company to the U.S. government? Why did, they push the IPO till next year? I guess that's called the S1. And you can't make it up on, CNBC. You actually have to have the lawyers okay whatever the statements are. And I think my guess, I don't know, is that it didn't read as well as he had hoped, and maybe some of the challenges in the customer concentration might be there. So the question is, what might happen? Well, if half of the, $2.1 trillion is committed by Anthropic and OpenAI, and the Anthropic, the debt that's being raised to build whatever it is, to spend whatever it is on Anthropic, is sort of like at the credit rating of the underlying guarantors. That's money good, quote. But the open AI, it's like, they might run out of cash in a few years. That could be a big rug pull. And
Yeah.
is it going to happen? I have no idea. Is it conjecture? Certainly conjecture. But I, you know, I believe in AI. I believe all this stuff's going to come. I believe it's in national security. I believe the data centers have to be built. I believe they're going to be in the United States. I think there's certain geographies that are more preferable.
Oh,
Uh,
we just learned why data centers need to be in the United States. So,
well,
because of that situation in the Gulf.
we've been writing about a lot of these things for a long time, and you and I have had offline conversations about some of these things. So we have these strong beliefs, which ends up in our portfolios. But um, what might happen, that might be it. Does that mean that these hyperscalers are, going to collapse? Absolutely not. But it might slow things down. So I do think that there's going to be some rotation. There always is. And you have to be aware that it's likely to happen, what parts, and protect yourself against it. But in my opinion, for people that are, investing for 5, 10 years, 15, 20 years, you need to have ownership exposure. So that's, I hope I answered that question. I don't know,
No,
I
I
don't know
think you
what
did.
path I went down.
Yeah, no, I think you did. Um, One of the things that I found a little weird as I was thinking about what you were talking about and some of these points, plus some of the second, yeah, you sent me that link, you sent me the link to the second order derivative paper, which I thought was fascinating, by the way, um, is that there are weird connections between these subjects. So, for example, passive investing um, and target date funds. If you were to look at what's in a target date fund, I will bet you that there's an awful lot of software and AI related credits. So
Absolutely.
these guys would have hoovered that stuff up because they were desperately looking for 100 beeps over whatever their bogey is to hit that target date allocation to fixed income, which is very large. So there's one connection to this mess or to the potential mess there. And then another thought that occurred to me was there's another solution to the problem you highlighted about growth or due to excess longevity, which is buying annuities.
Mhm.
If you're now for a high net worth individual, annuities are not a particularly smart product. Um, but for ordinary people, annuity is a good product. I look at annuities and I think, yeah, it's not a bad idea. I should park a certain amount of money. And then I think, except for the 300 beeps I'm giving away immediately and the lack of liquidity. But it's not, there's a case and my wife is probably betting on my longevity not being too great. And, I can imagine, right? Except then I look at who the annuity providers are. And the annuity providers, in many cases, are connected to private credit firms. There are some very big annuity participants who are linked to the private credit boom, and who therefore have been swallowing up another big block of some of these pieces of paper that we wonder about whether there's a problem with them in the future. So I just think it's weird how circular some of this. And of course, that circularity itself reminds me of some other classic market dislocations I've seen in the past, like the dot-com one, 2001, like the Russia crisis, and also like the GFC, where there's some weird circularities there. So I don't know. I mean, I don't know if I'm trying to connect too many dots and getting a weird shape. Go, oh, look, it's a UFO. Um, am I being nuts here?
No, no, I don't think so. Again, if you go back in history, things are the same, but they often rhyme. And few people probably remember what the S&L crisis was, but it was when continental Illinois, sort of collapsed, and that had never happened. And then there was a series of home loans that all sort of got called, and then it ended up in the RTC, and that was kind of part of the Drexel Burnham blow up, and
Hmm.
they started feeding it out. You mentioned the Russian crisis, and a lot of people probably, I don't know, the Russian crisis I'm thinking about was when the Soviet Union devalued their own currency by 90% overnight, and anybody who got, was part of that trade was absolutely hammered. Not a lot of people, some people went out of business, but and a lot of people didn't even know what happened. But the GFC, this piece that we were talking about, if
The
you
second order derivative piece.
second orders, it's
Yeah.
sort of it's not so much that yes, bad loans were made and people couldn't pay their houses and there was, fraud and what have you. But that was I was just writing today in something else where, sort of using that as an example, it wasn't it wasn't the fact, you know, loans were going up, house prices were going up, but it was the rate of change of they weren't decelerating, but they just weren't going up as much. And that triggered, that particular crisis. So it's always different, but I do think that there are some similarities. And just pulling into the private credit element, talk about a circular business there, that these guys are really all in the same business of not being forced to mark their own book down. So they're supportive of, buying loans from each other and, reconverting them as PIK loans or whatever. With the insurance companies, with life insurance or it's the annuities, you know, the inside baseball story is the reinsurance companies that, pop up to buy this paper, which, they own the insurance company, they originate the private credit, they do all the finagling there, they pull out, economic opportunity out of all these things, they dump it into an insurance company, they reinsure it in Bermuda, and it's all done, with papered correctly, so it's legal, what have you. And then what happens is it gets marketed on TV or someplace where, people have no idea and they're buying stuff and they're buying the highest yield product because it looks safe and maybe it has a good AM Best rating. I don't know. But sometimes these guys go through the lunch and learns and give out golf balls or whatever it takes to get people to push the stuff. So the this is where I get really a lot of energy around doing the right thing for people long term for the right reasons.
Hmm.
And sometimes I know I'm just screaming into the wind, but at this, but that's okay. And those are the things we want to protect our clients against. Yes, our clients don't buy annuities for the reasons you mentioned, but I think we should, yeah, I think it's a social obligation to identify the risks that are inherent in the market and also recognize the incentives of the people that are promoting certain parts of it, and whether or not their incentives are aligned with the ultimate buyer is sometimes not the case.
Yeah, I think this is what's a unique selling point, value proposition, whatever the phrase is. If you've been around markets a long time, you see recurring patterns. And I think you and I don't know if you're like, I think your ethos is you understand rule number one, equities go up. It's kind of important to bear that in mind.
I thought you were going to say, don't lose money.
Well, on a 20-year view, not losing money is
Right,
is being invested.
right.
Now, which
Absolutely.
equities go up, that can change. So having exposure is important. But I think I see there's a bunch of things I'm seeing now which remind me of things I've seen in the past. And the fact that I'm not shorting equities is because I can also remember that it takes an awful long time for the bad thing to gestate and to come out. And you point out that there usually is a lever the authorities can pull to delay it to the point where it's more convenient. And I've watched a whole bunch of levers being pulled recently and marveled at the imagination of some of these guys. Bill Pulte is pulling some really interesting levers right now. um, Mr. Besant and Mr. Walsh are both Soros graduates. They have a good idea. And I noticed, by the way, that Druckenmiller's Duquesne family office was long of, I think, is it XLF, which is a banking ETF?
I didn't see it, but it
If I
wouldn't surprise me.
He had a something like a 3 or 4% position in XLF, and it's up. It's up from where it did nothing for ages, but now it's up. Um, and the two and two that I was putting together to get five was that the the speeches that Walsh has given and other officials have given were pointed to uh, the reduction of the Fed's balance sheet as being a longer term objective and quite a sensible objective because most people would prefer the Fed not to make long term investments on behalf of us and for credit to be directed by the private sector. Generally speaking, the private sector is better at directing credit than the public sector. I don't think that's particularly controversial. And that means bank balance sheets are going to have to expand if the Fed's balance sheet is going to have to contract. Otherwise, there'll be, like musical chairs, there'll be kids who don't have seats. There'll be assets that don't have buyers.
Well, yeah,
Um,
but you remember last year, like 15 months ago, that was the Fed policy statement and where they were heading and some of the gradual easing. And I posited that maybe that was some of the, extra cash to absorb some of the private credit problems that might occur. So I totally agree with your premise. And if you not, this is total nerd out, but if you actually listen and read some of these releases and studies that come out of, San Francisco and St. Louis and occasionally Atlanta, San Francisco in particular, they float these ideas, like a year or two before it might
mm,
be needed. And
yep, yep.
so, I could be, grasping at straws or what have you, but I read, I find five bear markets in every two that occur. But these are the kinds of things that I think are happening. And, it's funny, a lot of people criticize how stupid people are at the Fed. They're actually not that stupid. They're actually pretty gosh darn smart.
Yeah.
And so there's a lot of times there's a reason for some of the things they're doing, and sometimes it's a year or two in advance. Sometimes it's late, but I totally agree with what you're saying.
The Ben Bernanke appointment to Ben Bernanke, I think, is a classic example of that point. If those who are familiar with what Ben Bernanke had written his PhDs on and his research agenda, he was an expert in what you do to avoid systemic collapse when you had a bubble that burst. And suddenly that guy comes out of Princeton and is shoved into the Fed as a governor. 2 years later, he becomes FOMC chair. The idea that was a coincidence is absurd.
Now,
They understood what was going on. They understood what they had to cover for.
and I think, Dalio, that 30-minute video he did, The Economic Machine, explaining the beautiful deleveraging and what have you, this essentially was a love letter to Bernanke and what he did. So, uh,
Right.
interesting.
He foamed a runway, and they knew they might have a runway that needed to be foamed. And I'm quoting Tim Geithner there with this rather controversial comments. Um, Before we run out of time, I just wanted to touch on that paper you highlighted with the second derivative point, because that paper framed the AI boom as as having more similarities to a real estate boom
Yeah.
than a technology boom, a
Yeah.
productivity enhancement. But there's a friend of mine and somebody who's been very kind to me and helped out. Um, Barry Knapp he writes on Substack as well, and he's an equity strategist. So Barry tells me that if you want to predict equities, the best indicator is not the first derivative of earnings, but the second derivative. And that when the acceleration in earnings disappears, that's when you should start to look out. And he argues that we're about to see earnings growth slow quite dramatically. Sorry, not earnings growth. Earnings growth will continue to rise for a while. Just like the article that you passed on to me. And I should, just for people listening, I should read out the title. It's from a guy with a website called Groundbreaker, and it's the second derivative, why no one understands the AI boom. And if I have any sense, I'll post links to these in the video post so that you can look at these papers themselves. What Barry told me was that if you look at the hyperscalers and the investments in AI, the investments are huge, but they're not accelerating anymore. The peak of the increase in investment has passed, and we're now in a phase where we're decelerating. So that growth in AI spending is coming down. AI spending is still positive and is still growing, but it's growing at a slower rate. And he thinks we've already reached the point where we've peaked in these things. And now the question is, when does it roll over? And it doesn't mean it rolls over immediately, but it opens a question up for him. And I thought that was fascinating that those two papers, that Barry made that point, and the paper you forwarded made that point, a similar point, anyway.
Yeah. I thought that article um, was very good and gave a little bit more perspective than perhaps I'd put specific facts to. It was the conclusion that we've drawn and the way in which we position our own portfolios. So that was gratifying, and maybe it's, someone in search of a confirmation bias. But I think it's, as you said, and as Barry said, it's always a second derivative, and it's even more so these days as the time horizons of the vast bulk of the money that moves the markets and securities prices is so short that nobody cares about, even sometimes it's not, the first derivative, it's just beating out the dark pool guy with the algo trades, or, trying to guess how the next index is going to, be repositioned. So fundamentals kind of don't matter to most of the participants. Um, but this is the difference between your time horizon. And if you are, if you are an investor that is investing for many years, and you want to be able to buy something of quality and financial structure stability, that's going to withstand, financial recessions and what have you, and in search of a compounding wealth accumulation, you need to know what these short-term things are. And so where's the money coming out of? Where's the big vacuum, the sucking sound, and is there anything worthwhile buying there? And where's it going? And when might that, when might that momentum stop? So that's how we look at things. And I thought that particular piece was extremely, extremely good.
It really was. Um, Chris, thank you so much for joining me. We've been talking for an hour. We should do it again. But I figure that whoever's on the treadmill and listening to this is
It's
probably
taking a
reaching,
shower now.
yes, they're reaching the point of exhaustion and they'd really
Yeah,
like to get a smoothie. So we should probably call it quits. Thank you so much. As ever, fascinating.
it's always a pleasure,
Useful
Harry.
stuff.
Thanks for having me on. I look forward to doing it again soon.
Speak soon.
Take care. Bye bye.
Bye.